After beating their earnings expectations, Home Depot is up by 4.81% as they did beat their EPS by 9 cents and their revenue by 630 million. Now, the company is benefiting from aging US housing stock and rising consumer interests in home renovations, but current macroeconomic conditions, mainly high interest rates, are negatively affecting the company, mainly because, well, people aren't buying that much houses and aren't doing that many renovations. The company is also trading at high forward PE ratio of 26 times. So jumping to my stock valuation spreadsheets, let's plug in the company's ticker and wait for all the metrics to show up. Now jumping straight to the 9 pillars, you can see that Home Depot is a 9-pillar company. All the pillars are sitting in the green. Now looking at their financial growth, their 5-year revenue CAGR is sitting at 4%, free cash flow at 3.67%, and net income at 3.62%. So their financials are growing very consistently, but they are growing in the low to mid single digits, which is quite low. Now, regarding their 5-year PE ratio and their 5-year price to free cash flow, you can see that the PE is sitting at 21.05. But if we zoom in closer to pillar 1, currently it is sitting at 27.19, which is quite higher than the 5-year average and quite higher than the average stock PE ratio. And regarding the price to free cash flow, that currently is sitting at 22.34, again higher than the 5-year average and higher than the average stock price to free cash flow. So Home Depot would be considered overvalued compared to the free cash flow and net income they bring in. Something I also like to have a look at is the decreasing shares outstanding, as by decreasing their shares outstanding, a company essentially increases their value as they have the potential to increase their earnings per share. And as we can see, Home Depot has been decreasing their shares outstanding at quite a decent rate of 1.62% year over year over the past 5 years, so that is great. And in fact, when I jump back to pillar 1 and scroll down, you can see that the EPS or earnings per share have been increasing very nicely over the past 5 years, although the net income has been moving up and down from 2022. So the company has been gaining value, partly because they have been decreasing their shares outstanding. Now, another metric I like to have a look at is the 5-year profit margin, which should be sitting above 10%. And as we can see for Home Depot, it is sitting at 10.14%, so it is just on the edge, but it is still above 10%, so this pillar is sitting in the green. But if I zoom in closer to pillar 6 and scroll down, the return on invested capital has actually decreased from 31% to only 22% in 2024, which means that the company has been spending more money to make less money over the past 5 years, which obviously isn't great. Now let's also have a look at Home Depot's dividends. If I jump to pillar 8, you can see that their 5-year dividend CAGR is sitting at 11.5%, which is extremely high. As you can see, the average stock year over year dividend growth is sitting at only 4.13%. So Home Depot is almost 3 times as high, and their dividend yield is also sitting at 2.34%, which is also above the average stock dividend yield. Now, their 5-year free cash flow is also sitting nice and low at only 50.61%, but when I scroll down, you can see that it has been increasing slightly over the past 5 years, so this is something I will keep my eye on. And now looking to the last pillar, and that is the long-term liabilities over the 5-year free cash flow negative dividends to be sitting below 3. And this essentially tells us whether a company generates enough free cash flow to cover all their long-term liabilities while paying out their current dividend. And as we can see, Home Depot will be able to pay off all their debt in about 10 years, which is great. So now that we have covered the 9 pillars, let's calculate the company's intrinsic value. So first, jumping to the Grams formula revised, I will predict the high EPS growth at 5.5%, medium at 4%, and low at 3.5%, and get an average. I will then take all these values, plug them into the Grams formula, and get an intrinsic value of $178.22, which is actually 55% lower than the current trading price. For the discounted cash flow model, I will project a growth rate of 4% into the future regarding the free cash flow, of course, and I will use this to calculate the future free cash flow. I will then discount it at a rate of 7.65% into the next 10 years plus, and adding all of that up, adding cash and cash equivalents, subtracting total debt, we will get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $321.11, again lower than the current trading price. Now, if you have gotten so far into the video, if you'd like to download these stock valuation spreadsheets for your own personal use, you can always do so at the link in the description. Now, moving back to the valuation, we will skip the multiples valuation as I don't really feel comfortable comparing Home Depot to any other company, and we will arrive straight to the dividend discount model, where we will take the dividend growth rate over the past 5 years and calculate an average of 11.49%. I will then project the growth rate into the future of 9.67%, but as the discount rate is lower than the projected growth rate, the intrinsic value will come out negative due to the mathematics within the model. And for situations like this, we do have the alternative model where we will get an intrinsic value of $479. And so finally, moving to the ultimate valuation, we will average out the three valuation models and get an intrinsic value of $326.15, which is actually 18% lower than the current trading price. And so with a margin of safety of 10%, we would get an acceptable buy price at $293.56. So the company would currently be either a hold or a sell, depends on your investing horizon. Now, don't get me wrong here, I really do like Home Depot. I love the fact that all the 9 pillars are sitting in the green and that they have steady financial growth. The problem is that they are overvalued compared to the earnings and compared to the free cash flow, as we just saw. So I personally will wait for the company to drop lower in price, and if they don't, I don't really mind, as there are so many other stable and undervalued companies I can invest into. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.